One of the long enduring mantras on Wall Street is you manage risk by diversifying, and the way we diversify is you own some stocks, and when stocks go down, you own bonds because bonds go up when stocks go down. Until they don't, which has been the case for the last 5 years. Bonds have gone down for 5 years in a row. Now, granted, to 2025, if the trend here at the last quarter continues, it'll be the end of the bond bear market. But so far, we need to finish up the year to know for sure that inflation does not rise and interest rates do not rise in accordance or in connection with inflation. So that's a problem to be resolved. We need another 3.5 months to go. My name's Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So 5 years of a bond bear market is not consistent with the sales pitch that comes from Wall Street. If you're worried about risk, and the older you get, you're supposed to be worried about risk, the more bonds go in your portfolio, which did work for 4 decades while interest rates dropped lower and lower as inflation got lower and lower.
Sure.
But when interest rates go up, bonds go down in value. And that's basically the environment that we've had since the peak of the COVID rally. And that's a problem. And finally, we've got 2 competitors on Wall Street, JP Morgan and Morgan Stanley, who are finally throwing in the towel on modern portfolio theory, at least a little bit. They're letting the laundry get dirty anyway, and no longer saying that everybody needs at least 40% bonds. So what are the new hedges? Well, they're hedges that people have often accepted without really getting an endorsement from Wall Street. One of which, the most common one, is gold. Gold is considered to be an inflation hedge, though for years I've argued it's really a crisis hedge. So when wars show up, gold gets really valuable. We've had inflation when gold did not go up. And the real reason for gold and inflation correlation goes back to the 70s when President Nixon took the dollar off the gold standard, basically saying we can't afford to leverage our government if we're stuck with a dollar that's worth something. So let's make it less worthwhile, less valuable, get off the gold standard so we can make believe whatever the dollar is going to be.
And that's quite frankly a big part of the gold market has been forever, ever since the gold has been discovered and mined. There's been a substantial group of people that don't really care how gold is doing at any given moment. It's always a great investment. It's always a good time to accumulate more. And so when Wall Street's looking around and saying, okay, bonds have been out of bed so long here that it's hard to pitch them as this great diversifier against an equity portfolio anymore. What could we slot in there? And moving to something like gold feels really good. It's like, okay, there's a lot of people that are just itching for a reason to buy more. The people that are less than the true believers that own it no matter what, saying, well, now we should sell you a chunk of gold just because as a diversifier and just hold on to it forever. People are like, well, okay, let's do that. And there's no ongoing cost to holding gold most of the time. So Wall Street's got to be a little bit hesitant to say, well, let's buy a hard asset and just ignore it. That kind of immobilizes a piece of the portfolio. But that's their first bid. That's the first place they're heading right now.
Well, part of the problem for Wall Street, and the reason I prefer bonds, is bonds eventually mature. And so when they mature, they have to be reinvested. Gold doesn't mature. Gold is. And that's all it is. So if you put gold in the portfolio as a diversifier, it doesn't generate a lot of ongoing commissions. There's not a lot of spread between short and long maturity. It is well, we'll take the hit on our income to remove the problem of bonds losing money over a much longer period of time than anybody expected. So the other reason it's currently acceptable is because of the increasing doubt about the credibility of government institutions.
True.
Since COVID, the amount of trust in government, it's not just the United States, it's around the world.
Yep.
The trust in government entities has cratered. Gold is an escape hatch for that, so it's an easy transition. Now, if the problem was really inflation, the better hedge there happens to be oil. So Wall Street is transitioning, and we'll see more of it. With JP Morgan and Morgan Stanley are on the same page, others are going to follow, that the 60-40 portfolio is now a 60-20-20 portfolio, so we can maintain some appearance of risk management even though we are giving up our bond turnover benefits. Now, benefits for Wall Street, because the turnover in bonds generates revenue, even though your bond portfolio looks substantially the same, it's different on the inside of a Wall Street firm. Those bonds are revenue generating entities, which is something in my early career I didn't fully understand why so many brokers concentrated on just selling bonds.
Sure.
Because it basically built in a guaranteed sale 2, 3, 5 years downstream. And the bigger the portfolio, the more bonds there were in it, the more turnover there was in it. It made it easier to make a really handsome living, even though commissions were smaller than on stocks back in the 70s and early 80s. That's just the inherent conflict of interest that Wall Street has.
Yeah, and with gold, like you said, with gold right now, it's not just a portfolio issue. They can couch it as saying, well, there's a lot of geopolitical risk right now, and nobody really trusts the major institutions worldwide. So here's a real hedge for you, something that has existed for thousands of years, and everyone understands it. Everybody knows what gold is. Everybody knows what gold does. And so it gives them another reason for you to own it, and it's not directly linked 100% to the portfolio returns, because quite frankly, that may not work out, which is what, we've never had in Investor Resources. We've never had a permanent gold position. Well, we're going to put, some of your portfolio on gold, and we're going to leave it there. If gold's doing well, it can make it in. If gold's not, it's not. It's just another investment asset. And how they're couching it as, well, no, it's insurance against potential policy mistakes and geopolitical errors, and so it's more important to you that way. And that's another way to cement that into your portfolio and give them another talking point other than, well, yeah, it's really not making any money, is it? But remember, we bought this because we don't trust the government. So there you go.
Well, you raise a couple of issues. One, we do have two wars going on. We have the Ukraine war going on with Russia, and we have the Mideast between Hamas and Israel. So we have crises that are real, and nobody knows where they're going to go. And then with the drone invasion by Russia into other EU, Poland is, I think, specifically. And I think they skirted another country over there, raising concerns of bigger war. And of course, in our background is Taiwan and China, which is just always on the brink of this.
Right on the edge. Yep.
Turn into a big flare up, and we'll be in military conflict. So that fear is there. And I have to ask, since Wall Street's full of conflicts of interest, these major Wall Street firms have been raising their target for gold in recent weeks to $4,000 or $5,000 or $6,000 over the next year or two or maybe three, but it's going to be much higher. You almost kind of have to ask, is that part of the justification for moving the 60-40 to 60-20-20? We don't know, have no idea, but it does look kind of suspicious that the increasing forecast in the price of gold happens to go along with the change in portfolio allocation, which kind of increases the demand to go buy that gold.
Well, there you go. Yeah. So is this an organically growing market sector, or is this being pushed an item that's being sold? And and the answer is, of course, there's no way to tell for sure, and it's probably both. Gold has been doing well in its current cycle, and Wall Street can seize on that and say, well, see, it's already been doing well. We should pick up some. Oh, yeah, and here's some brand new reasons why you should own this if you don't. And those dovetail together. Sales go up, prices go up, like you said earlier, Don, until they don't, and then you deal with the shakeout then.
Yeah, and we saw that happen in summer of 2011. We were on the radio at the time, and at that time, this is mid-June, and we basically said, based on our charts, gold has run its course, and if you're in gold, now's a good time to take some profits. If it's liquid, then get it out of the portfolio.
Go now, yeah.
And from 2011 to 2024, I mean, that's a long time to be underwater in an asset.
Yep.
And that's a risk with gold. Now, there are some arguments that demand actually is increasing that's not necessarily tied to the change in modern portfolio theory application, and that is central bank acquisition. But that comes back to government, lack of faith in government, specifically the U.S. government and its debt problem, this federal debt and deficit issue, because central banks are trying, and many emerging market central banks are trying to get away from buying treasuries for their own backing of their own currencies.
Sure.
So they're buying gold. And the expectation is, with China pushing the movement to quit using treasuries for currency support around the world in what's called the BRICS movement, the demand for gold is higher. And there's two ways to benefit from that. One is you can add gold. The other one is you can add gold mining companies, or in the fund market, gold miners or gold junior miners, which are much higher risk companies. I mean, they typically have very poor financials. But unlike in 2011, when gold was forecast to be falling for an extended period of time, gold miners were stuck with hard costs. So they would sell their gold at a given price, and their cost would continue to rise. And the next time they sold gold, it would be an even lower price. This put a lot of economic pressure, financial pressure on the fundamental values of mining companies. Yep. That's a reverse situation. Assuming central banks are going to be buying gold for a number of years, gold miners get to sell their future production at higher prices, and they should become a profitable asset allocation segment, at least for a while. But mining companies have a volatile history attached to them, and you should not buy them unless you are pretty comfortable with what you're doing and your financial advisor says, yeah, it fits in with the other stuff you're doing, without regard to JP Morgan and Morgan Stanley saying, you don't need bonds anymore, it's 20% allocation to gold. That's a totally different decision than looking at what's going on in the business of gold.
And of course, we would not recommend anyone buy anything and just put it in their portfolio and walk away and leave it there forever. Things are going to go through, they'll have long cycles where they're doing very, very well, and that will change. It doesn't matter what it is. It doesn't matter what market sector it is. It doesn't matter if it's technology. It doesn't matter if it's real estate. We've all seen that go through decades of just fantastic growth, great returns, and then it changes. Gold is no different. Bonds are no different. There are good times to own them and times where it's not so great. And so you need to pay attention to the data. You need to pay attention to cash flows. Is money coming in or is money going out? And treat it like any other investment. And don't get bogged into hey, the world just changed. You should have 20% of gold in your portfolio forever. Not likely the case.
So if you like what you've heard today, share our podcast with a friend. If you haven't signed up yet, subscribe. There's a link right down here in the bottom somewhere that you can subscribe. If you want to talk to us about your portfolio, you got questions, somebody's trying to sell you something you're not quite sure you understand, you want a second opinion on it, just give us a call or send us an email. We'll be glad to chat with you. Thanks for being with us today. Subscribe and stay tuned. Be ready for more.